Warren Buffett, the legendary investor, once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This is one of the core philosophies that helped him build his financial empire worth billions of dollars. Instead of merely looking for cheap investment opportunities, Buffett encourages us to focus on businesses with strong foundations and long-term growth potential. In today's video, we will explore the 9 key principles that Warren Buffett has applied to build his massive financial empire. Stay tuned, because by the end of this video, you will understand all of these principles. If you find the content helpful, don't forget to subscribe and turn on notifications so you won't miss any upcoming videos. Let's get started. Principle 1. Invest in wonderful businesses, not cigar butts. At the beginning of his career, Buffett used an investment method he called the cigar butt approach. This strategy involved looking for very cheap stocks, similar to finding a discarded cigar butt on the street. It might look ugly, but it still has one last puff left. In other words, this strategy focused on low-priced stocks that could still generate small profits. However, Buffett soon realized that this method was not sustainable and wouldn't yield large profits. Instead of focusing solely on cheap prices, he shifted to investing in wonderful businesses at reasonable prices, meaning companies with long-term growth potential and significant value. Warren Buffett explains, "I was taught by Ben Graham to buy things on a quantitative basis, to look for things that are cheap. This had a strong impression on me in 1949. So I went around looking for what I call cigar butts of stocks. The approach is like walking down the street, looking for discarded cigarette butts. You find one that's really disgusting, soggy, and ugly, but there's one last puff left in it. You take that last puff, although it's disgusting, but it's free, meaning it's very cheap. Then you keep looking for the next cigarette butt. Although you can make money doing this, you won't make big money. Now, I prefer to buy wonderful businesses at fair prices rather than buying fair businesses at wonderful prices." The cigar butt refers to how Buffett described investing in cheap stocks that lack much growth potential, akin to picking up a discarded cigar butt that can still be used but has little left to offer. While this method can bring in small profits, it doesn't help investors earn large, long-term returns. Buffett applied this new mindset to one of his most famous investments in Coca-Cola from 1988 to 1990. Buffett decided to invest $1 billion into Coca-Cola and has held on to this stock ever since. The value of the Coca-Cola shares he holds has now grown to $25 billion, and he receives $700 million in annual dividends. This clearly demonstrates the success of investing in wonderful businesses. Sometimes I call this the hold to die strategy. The reasons Buffett decided to invest in Coca-Cola, as shared in his letters to shareholders, include: 1. Essential product. Coca-Cola is a brand that has near absolute pricing power on a global scale. 2. Growth potential, especially in international markets, particularly in developing countries. 3. Impressive returns. This investment has grown 17.4 times over 30 years, with an average annual return of 28.2%. This strategy not only helped Buffett achieve great success, but also serves as a valuable lesson for investors. Don't just look for cheap investments. Focus on businesses with long-term potential and value. Stay tuned to discover the other principles he has applied to achieve such success.